And now let's kick off this section with an example question.
SOX requires management of issuers to do all of the following. So again, remember this is a code word for public company and it's the same as registrants. So you should know all these code words because they always show up on exams. One thing I want to point out before I read this is when it says SOX requires management of issuers to do all of the following, it's not specified here the size, as in we don't know if they're accelerated. So that's one important thing just before I even read the answers. It doesn't specify if it's talking about accelerated filers or not. So I know that in terms of requirements, I'm going to be wanting to look for things here that relate to 404A or section 302, right? Because I want things that actually apply to everybody. Whereas if something relates to 404B, it wouldn't apply to everybody.
So now let's take a look at the answer choices.
So establish and document internal control procedures and include in their annual reports a report on ICFR. So that's part of 404A. And provide a report to include a statement of management's responsibility for an assessment of internal control. That's 404A, and they also do that as part of 302. And provide identification of the framework used to evaluate the effectiveness. Yes, we said that in their 404A opinions, they're always talking about the COSO framework. And then D is provide a statement that the board approves changes in internal control procedures. Like, no, we never saw anything like that. So D is clearly answer since this is an accept question. So obviously the answer was not some kind of 404B requirement, but it could have been. They could have had something like D could have been have auditors issue opinion, and it would have been a correct answer because that doesn't actually apply to every single company under SOX. Okay, so what is the goal of SOX 404? Well, we know reducing control risk is a big one, right? Because the whole idea is with better internal controls, we can reduce opportunities to commit fraud, which will reduce control risk. And we also know, thinking about the COSO framework specifically, a couple of parts that are specifically impacted by the sections of 404 we talked about. One would be the information and communication, because part of it, the information and communication, one of the principles talked about communicating to external parties. And 404A, 404B, Section 302, those are all about kind of communicating to the shareholders about the state of internal controls. And the monitoring section was talking about the ongoing and separate evaluations, which we see that the separate evaluations are happening as part of 404A and 404B, right? You're evaluating your controls for effectiveness so that you can issue these 404A and 404B opinions. Okay, a few definitions. So this is a formal definition. This is really the PCOB definition of internal control. And it's not all that different from the other definition we saw in chapter 6. One thing I want to point out about this definition is it references disposals a few times. So it talks about how you need to have controls that accurately and fairly reflect transactions and dispositions of assets, make sure all transactions are authorized and recorded, and prevent or timely detect unauthorized acquisition, use, or disposition of assets. So we notice a couple things here about disposition of assets. There is an advanced module that is about a paragraph long at the end of this chapter, which you do need to know. And it talks about this idea of asset disposition and controls over operations versus controls over financial reporting. And what effective controls mean from these two contexts. So if you have effective controls over operations, that would be more about preventing the disposition of assets in the first place. And sorry, I should say not preventing all disposition of assets, but preventing unauthorized dispositions. But the ICFR controls, remember, these controls are about how I report the things that have happened. And so the ICFR side of this is making sure, okay, if there are unauthorized dispositions of assets, this amount actually gets recorded in the financial statements. Okay? So the difference is this one, right? It's focused on company operations. It's focused on, which those operational controls really are all about things like effectiveness and efficiency and things like that. Right? Making sure the company is operating at its best. Controls over financial reporting are really making sure we have truth and accuracy in reporting. It's making sure the accounting is good. So did I accurately account for things that have happened? Am I recording history accurately? So the financial reporting aspects of an unauthorized disposition is not whether or not the unauthorized disposition happened, right? Like, you can still have a good financial reporting control and you can have a bad operational control, right? So my operational control over here can fail, right? I can have an unauthorized disposition, but my financial reporting control can be effective or good as long as I am capturing those unauthorized disposition and recording them accurately in the financial statements. So check it out. There's, again, like I'm saying, there's a little paragraph at the end of the chapter in this advanced module. It talks about these unauthorized dispositions from this operational versus financial reporting perspective. And it's just an important concept to make sure you understand how you can have kind of something that's ineffective from an operational standpoint, but it is operating effectively from a financial reporting standpoint. Okay, so I want to quickly talk about the different types of internal control deficiencies that you can have. And these are going to become a central topic for the rest of the chapter. So first off, you can have just a control deficiency. And this is typically what we'll say happens if a single control fails. It doesn't operate properly, and it fails to prevent or detect a misstatement on a timely basis. Okay, so just one control fails, and because of that, an error wasn't prevented or detected. So this can be any control. It can be my control that I love to use an example. It can be my every purchase over $5,000 needs 2 signatures, right? So it can be like, okay, when I tested that control, I did a test of 25 and it only worked 20 times out of 25, right? So that one control failed. And because of that, a couple of those purchases that didn't get 2 signatures were unauthorized. They shouldn't have happened, right? So that would be an individual control deficiency. But those 2 purchases weren't really material. They were still small if you compare it to the company's size as a whole. I'm going to skip significant deficiency for now, and you'll see why in a minute, and go to material weakness, which this is the really bad one. So this is the one we're really worried about as auditors. So material weakness is a deficiency, or more likely a combination of deficiencies in ICFR, so that there winds up being a reasonable possibility. So note that it's reasonable possibility, not definite. Okay, so reasonable possibility that a material misstatement of annual or interim financial statements will not be prevented or detected on a timely basis. So this is when I have a control failure, or like I said, combination of control failures that is so bad that management hands me a set of financial statements, right? And it can be end of the year or like annual, or it could be interim, like maybe they handing me their 930 financial statement. And they believe, right, that those financial statements are 100% correct. They have done all of their reviews, and I find in those financial statements a material misstatement, right? So they've gone through all the various levels of review, but clearly there was a material misstatement in there. It was not prevented or detected by any of the controls throughout the process. And a significant deficiency. So the reason why we saved this one for last is because it's basically the kind of definition of the significant deficiency. It's very judgmental, but it's a control deficiency or combination of control deficiencies in ICFR that is less severe than an MW, but important enough to merit attention by those responsible for oversight. So let me explain what it means there. Why does it say important enough to merit attention? That's because if we label something as significant deficiency, what that means is we are going to be informing the audit committee about it. And the idea is the audit committee is one of those parties that is quote unquote charged with governance, and they will be able to enact changes to fix the problem. So we're elevating this over the level now of a control deficiency, which only management would be hearing about or knowing about. I'll say only management hears, knows about. And material weakness, the public knows about it. Okay, and so a key here, it's not a material weakness, so it's not reasonably possible that whatever this is, it's not reasonably possible that it's going to result in a material misstatement. So that's key there, because that's what defines a material weakness, right? But it's worse than just a regular control deficiency because we think it's important enough that the audit committee needs to hear about it. And you'll notice here we have kind of this little part here that, okay, we need a lot of judgment to figure out what category these deficiencies fall into. And the main way we figure out what category these things fall into is we look at the likelihood versus magnitude of the problem. And I have this little slide over here, which shows this idea of likelihood versus magnitude. And likelihood, it means of misstatement, and magnitude is also of misstatement. So if you don't think there's any likelihood of a misstatement occurring, if the likelihood is only remote down here, then something wouldn't even rise to the level of a control deficiency. But if we're at least in this reasonably possible or probable category, then we're in this section where it's control deficiency, significant deficiency, or material weakness. So really the main thing that is determining which of these categories it falls into is the magnitude here. So if it's not going to result in material misstatements at all, then control deficiencies, if we think they're material, reasonably possible that there will be a material misstatement in interim or period end financial statements, then material weakness. And if it's somewhere in between the magnitude, then a significant deficiency. And this has the reporting things, which I was noting on the last page, right? The control deficiency, only management will hear about it. Significant deficiency, now the audit committee is going to know, and the material weakness will be reported externally. And so the shareholders are going to know about it.
And it will be reported externally via the 404A and 404B reports.